Buying or listing a home in November and December is not for the faint of heart. I mean, the holidays have already started pulling our attention, and shoot, we're still recovering from an intense election cycle and whipsawing mortgage rates. The uncertainty of today's environment justifiably has many sitting on the sidelines, but not everyone. I mean, seasonally, this time of year gives an advantage to home buyers because sellers who are on the market are also trying to juggle kids and gifts, a clean home, and showings. And they're typically only listing because they need to sell. This year, however, buyers have an additional benefit beyond the typical seasonality due to lower than normal demand and higher than average inventory. I want to break down the advantages today's buyer has, where experts think rates and home prices are going, and why waiting could end up costing you more. I'd also like to highlight 3 strategic moves many of my buyers are taking advantage of in today's market. But before I get ahead of myself, I'm Nicole Ruth, SVP, real estate investor, and mortgage professional of over 23 years. And if you find any value in this content, do me a favor and hit that thumbs up button below and subscribe to my channel so you never miss a weekly housing and mortgage market update. Now, don't get me wrong. I'm not telling any buyer who feels uncomfortable to jump in anyway. I don't want anyone on my watch regretting a move they made. However, I don't want anyone saying I didn't tell them what could happen next. So let's talk about 2025 for a minute. Leading experts have started releasing 2025 forecasts based on the current Fed's position of relaxing their restrictive stance, juxtaposed with the increasing risk of tariffs, higher inflation, and a stronger economy. These opposing forces have many believing rates will stay higher for longer. In fact, Fannie Mae published their rate projections of 6.4% for 2025 and 6.1% for 2026. The Mortgage Bankers Association, or MBA, sees rates averaging at around 6.4% in 2025, dropping only to 6.3% all the way through 2027. The National Association of Realtors predicts rates to settle slightly above 6% through 2026, and the National Association of Home Builders is calling for an average of 6.12% for 2025. Now let's talk on home price projections. Because with higher for longer rates, wouldn't home prices seemingly drop? It seems logical and certainly discussed prolifically online as to the need for home prices to fall in line with affordability. Yet, the Federal Housing Finance Authority, or FHFA, just released their higher conventional loan limits for 2025 based on their estimated year-end 2024 home price growth of 5.2%. Even with rates spiking above 7.5% and the volatility of the economic and political environments, home prices didn't falter. Let's look at a few of the other home price indices. The Case-Shiller Home Price Index, which is the gold standard for appreciation, just published their September data, showing a 3.9% year-over-year price growth nationwide, with the top 20 cities, of which Denver's included, increasing 4.6%, and their top 10 cities up 5.2%. FHFA also released their September data, which measures home price appreciation on specifically single-family homes with conforming loan amounts. Year over year, home prices are up 4.4% per FHFA. Now, jumping over to our local Denver data, even with November's typical seasonal slowdown, year over year, the median and average home prices are still up 3% and 5% respectively. Going into 2025, Fannie Mae is projecting another 3.6% growth in home prices. MBA is projecting 1.5%, and NAR forecasts 2% growth for both 25 and 26. While these lower than historical average annual home price growth numbers will slightly help with affordability, they're not indicating signs of declining. Higher home prices and higher for longer interest rates don't exactly sound like a buyer advantage. And I'm totally with you on that. So let's also throw in today's inventory story into the mix. Nationally, inventory is higher than it's been since June of 2020, working its way steadily towards pre-pandemic levels. Locally, Denver saw our current 9,300 units for sale last during the summer of 2019. Then, not since November 2013. This additional inventory is giving buyers choices and sellers a need to stand out. But the excess inventory is fading fast. Sellers waiting till spring created a drop of 41% month-over-month in new listings. Add that to a seasonally lower, but year-over-year higher, closed unit count of 3,022 units, active inventory dropped 15% from 10,940 to 9,310. This inventory count will continue to drop over the next few months as buyers scoop up deals and sellers wait for spring. So let's double click on those buyers scooping up said deals. Of the homes sold in November, about 50% had made at least one price reduction before going under contract, and roughly 60% of the sellers provided concessions to the buyers, many in the form of interest rate buydowns or repair credits. Buyers who recognize home prices in the long term always go up and interest rates are always refinanceable are looking at today's higher inventory as choices and today's higher prices and mortgage rates as competition limiters. In fact, any slight dip in rates or even their consistency demonstrates this in an increase in mortgage purchase application data. We saw this in September when rates dropped to 6.11% and mortgage purchase applications spiked 10%. And then again in November as post-election certainty and rate stability, even if it was at 7%, increased application data by 16%. As a potential buyer looking for a holiday deal going into December and January, here are 3 strategies to consider. First is the buy before you sell strategy. This is a tool that we're using a lot as homeowners are looking to jump into a new home for a discount. But of course, they want to sell in the spring at full price. Now, while nothing is guaranteed, the spring market will traditionally have more buyers competing for homes to purchase, pushing up prices and/or limiting a seller's need to provide a concession. This program allows a buyer to use their current home's equity while also removing the monthly payment from their debt-to-income ratio when qualifying for a new home. A second strategy is using an interest rate buydown or seller credit to pay off debts to help offset higher mortgage payments. Many don't realize that if you're a veteran, a seller can pay off your debts to help you qualify for more home. A non-veteran can also look at redistributing monies needed for closing costs towards debt payoff when they get a seller credit for closing costs. Rate buydowns are extremely helpful for giving a buyer temporary relief, assuming their wages will increase or rates will decrease over the next 1 to 3 years. A third strategy is negotiating time and credits for a home renovation loan. Many of the homes sitting on the market today need a little TLC. With days in the MLS increasing another 12% this month, sellers are more willing to give longer closing timelines to allow a buyer time to get a contractor and the bids required for a renovation loan. Imagine your ability to have the home of your dreams done for you. This is just another gift of today's market. Bottom line, we don't actually know what 2025 will bring yet. We don't know how intense the spring market will heat up or how long it will take for rates to drop. What we do know is that buyers have an advantage that some of them know and others still feel uncertain about. Apartment List just put out a study of how rent burden has reached an all-time high, with 52% of renters paying more than 30% of their income on their rents nationally, and 53% here in Denver. Choosing to wait might just give you a lower interest rate, but I'll ask, at what cost? Well, that's a wrap. Until next time, this is Nicole Ruth, proud sponsor of the DMAR Market Trends Committee and market leader with Movement Mortgage.